Global Finance, Topic 11B, Foreign Exchange Earnings at Risk, or EaR, by Lou Gaddis. The objectives are to understand the methodology of calculating EaR, what are the assumptions of it, what does it mean, and then just calculate EaR for an FX position. So we start with where we left off the last podcast. In that podcast, we looked at stress tests. So let's do a different example of a stress test. Say a company just purchased an $80 item, or say an accounts receivable. That's worth $80, and it was booked at $1.30 per euro. So the book value on the parent's financials, say a U.S. multinational firm, has an 80 euro asset at $1.30 a euro. It's sitting on the books of the American's financial at $104. In 60 business days, the year-end accounting statement will be published, and the firm uses the current rate translation method, in which all translation gains and losses affect earnings. So in other words, we're going to have to revalue this 80 euro asset at the new exchange rate. So the first thing we can do is a stress test. A popular one might be to just look at a plus or minus 10% appreciation or depreciation of the currency and see what the gain or loss would be. If the euro to appreciate 10% from $1.30 to $1.43, a 13-cent increase in the euro, the position is now worth $1.14 or be a $10 gain. If the euro were to depreciate by 10% or down 13 cents to $1.17, the position would be worth 93.6. So we can say that our exposure is $10 to a plus or minus 10% change in the exchange rate. The downside of this method is that we're not really sure how likely, say, a 13-cent change in the exchange rate is over 60 business days. So we're going to look at something called EaR, earnings at risk. That looks at the historical volatility of an exchange rate. And then using that, we can forecast the volatility in the future and then adjust it, making some assumptions on the distribution of the exchange rate. So the first thing I would do is maybe go to my Bloomberg terminal. I'm thinking about the volatility, how volatile the euro is going to be over the next 3 months. And I look at a function in Bloomberg, WVOL, which is world volatilities. And I can see that the euro has an expected volatility of 13%. Now, where these numbers are obtained is by looking at options. So the 3-month at-the-money options on average are showing that implied volatility of 12.898%. So there's my 12.898%. So if the current exchange rate is $1.30 and the Black-Scholes implied volatility annualized is 12.89%, we can say that the volatility of the exchange rate is 17 cents per euro. And then using the square root of time rule for scaling volatility, we can scale, say, an annual volatility of 17% to a daily volatility. Assuming, say, 260 trading days in a year, you would divide by the square root of 260. So you would see that the daily volatility is 0.0105, or about a penny a day. So that now we know the daily standard deviation is 1.05 cents per day. If we make another assumption that changes in the exchange rate are normally distributed, in other words, have that bell-shaped curve, we can then use the properties of a normal distribution and make statements like, what is the probability of having, say, a 5% worst case change in the exchange rate? In that case, if you were looking at a textbook on statistics and look at a normal distribution table, you'd see that it's a 1.65 standard deviation change away from a mean would only have a 5% likelihood of happening, and that would be a one-tailed test. So what we say is there's a 5% chance of having an adverse 1.65 standard deviation change away from our mean. And if we're looking at, say, daily means, right, daily distribution, we might say that the daily mean is 0, so the chance of having a 1.65 standard deviation change or more would be 5%, or a 95% chance of not having a 1.65 standard deviation change. So in EaR, the formula is given here, VZ, daily standard deviation times square root of days. And you see that we always have to state an EaR for a given time period, say T days, for a given confidence interval. And that confidence interval is usually 90%, 95%, or 99%. So I want to make statements with 90, 95, or 99% confidence over the next T days of what the losses could be. Now, the V in this equation would simply be your position in the foreign currency, say. And the last example was 80 euros. The standard deviation would be the daily standard deviation of the dollar per foreign exchange rate. Days would be when you expect the accounts to come due or when the financial statements are going to be published. Now the Z depends on whether you chose a 90, 95, or 99% confidence interval. And I'll give these to you if you need them on an exam or a project. If you choose a 90% confidence interval, the Z is 128. If you choose a 95% confidence interval, the Z is 165 and 233 for 99%. So let's go ahead and calculate it, and then we'll talk more about the confidence intervals. So let's look for a 90% 60-day EaR of the position of 80 euro asset where the exchange rate is 105 cents per euro. So just plugging in the values for my EaR, I would take my 80 euros. Now the Z, if we want a 90% EaR, that's a Z of 1.28. My daily standard deviation of 105 per euro. Here's where my euros cancel out. And we're going to scale the standard deviation by the square root of 60. Now this term here, what effectively it does, it gives you the 60-day standard deviation. This number turns out to be 8.3. So let's interpret that. The 90% 60-day EaR is $8 million. So what that means is you are 90% confident, right, 90% confident that you will not lose 8.32 million or more. But if you'd like to be a pessimist, you can also say that there's a 10% chance of losing 8 million or more. Now, if you were to choose a 99% confidence interval, so a 99% confidence interval, I would do the same math, but in here I would just use 233. That number now is going to get bigger. And you can make a statement like, I'm now 99% confident that losses will not exceed whatever that new value is. And again, your Z values will generally be 128 for 90% confidence, 165, and 233, and they're simply derived from the normal distribution curve. So in this section, we tried to look at the methodology of calculating EaR and calculating an EaR for an FX position, where we said that the EaR for some confidence interval x over t days is going to be v times z. That z depends on the x. That z is going to be 128, 165, or 233, depending if you choose a 90%, 95%, or 99% confidence interval. The daily standard deviation, that's going to be $ per fx times the square root of t days. Also note that v, we're going to usually use the absolute value, so it doesn't matter whether it is a receivable or a payable. We'll just put in the 80 euro, whether it's receivable or a payable, because usually EaRs are quoted as a positive number, so we usually take the absolute value of it. It's just the interpretation is different. For example, if this problem said an 80 million euro accounts payable, I would still calculate $8.32 million as a EaR. It's just the interpretation of it. I would then say, okay, I have an 80 million euro payable. There's a chance it'll cost me $8 million more to pay off the liability. So that's earnings at risk.